lira as well as for the Argentine peso. How much of that are idiosyncratic factors, and how much of that is the lack of resilience to a stronger dollar?
It's a combination of both things. The market gets very comfortable selling dollars and owning emerging markets when global synchronized growth becomes a theme, when everything's looking nice and stable and nice and healthy and growth is kind of trucking along globally and things look good. The market's very comfortable owning a wide variety of emerging markets. Once things get a little shaky, yields come back into focus as they rise, the dollar starts to move higher, then people look at the local fundamental story and say, okay, wait a minute, I don't want to be involved in Turkey, I'm watching out for the Mexican elections, I got to be careful in this place or that place, and you have to sort of pick and choose. So you may end up with places like Asia and EMFX has been more stable in these cycles, these mini cycles, than we have seen in LATAM FX, for example, which will take the brunt of the pain, or Turkey, which always takes the brunt of the pain, especially when energy is rising along with it. So I think markets get selective when the dollar starts to rise, and then everyone kind of closes their eyes and buys everything else when the dollar starts to fall.
So where are we still seeing carry value?
There's still plenty of carry value out there in some of the places where people are comfortable taking risks, like maybe Indian rupee, for example. As you mentioned, Philly, you're taking some risks there. There's clearly other fundamental drivers you have to be careful on. But you're losing a lot of carry in places that traditionally were the high carry players, like Aussie dollar, Kiwi dollar, no longer carry plays. Even shorting the euro is an expensive proposition these days, similar to shorting the yen. So the carry differential story is definitely much more in favor of the dollar than it ever has been, and yet the dollar is viewed as a funding currency, largely because in some cases it has to be, just the way folks have to invest and that sort of thing. But it's kind of an interesting dynamic how much that's changed in the last year and a half.
Brad, real quick, the cross for the next 2 minutes, how you plan it?
Which cross? I'm sorry?
Well, which cross? I'm asking you. Which cross are you playing the jobs number? What's the trade over the next 2 minutes?
The trade over the next 2 minutes is definitely going to be dollar yen. That's always the one that's in the crosshairs on NFP Friday. But you have to look at euro yen as well. I think it's interesting that the yen has sort of outperformed the Swiss, for example. Dollar yen has come a long way, sort of led the move. So I could see euro yen falling while dollar yen falls and the euro dollar falls. So if you kind of got that euro weakening while yen maybe strengthening a touch. So it'll be interesting to see how that reacts to NFP today.
All right, Brad Bechtel of Jefferies, thanks very much. Great to catch up with you before the number. Still with us, Alan Kruger of Princeton University. Final thoughts in the next 90 seconds.
I'm going to be very curious to see what happens with manufacturing employment. I think a stronger dollar is going to start to affect trade before long, and that could be reflected in manufacturing.
Yeah. So, and what about education? Because we actually just had a note from one of our colleagues who said, watch education. I think it might be an outlier there.
The education sector, that well could be. Seasonal adjustments are always hard with education, but I wouldn't think that April is such a difficult month for seasonal adjustment for schools.
All right, Alan, hang on. We're going to get the jobs number in just a few seconds. I just wanted to check in on the markets and where we stand into the numbers. So it feels like we're in a tight range waiting for that. The Dow Jones, though, about the lows of the session, off by 75 points in the futures market. The dollar spot index modestly higher. It's a G10 currency story as euro dollar grinds lower. European stocks also down by up by about 0.2%, and buying on the long end seems to be the trade. Flattener for the 210s and the 530s as the 10-year yield grinds lower, about 2.93%. So now we want to get to the latest read on jobs with Bloomberg's Katya Dimitriev. She joins us live from the Labor Department. Katya?
164,000 jobs were created last month in the U.S., far below what we were looking for, the 192. But the unemployment rate we were looking for 4, it's down to 3.9%. So very tight market. March was also revised up to 135,000, bringing the March and February gains up from the number we had there to 30K additional jobs. All of the jobs are in the private sector. Government jobs actually down 4,000. Average hourly earnings up 0.1%, below what we were looking for. Year-over-year gain is brought up 2.6%, also below 2.7% that we were looking for. Participation rate, little changed at 62.8%. We were looking for 62.9%. And average hourly hours worked, unchanged, also at 34.5. We've got the marginally attached, or the U6 rate, 7.8%. This is the lowest since July 2001. In the manufacturing sector, this is really going to be one of the stories of the day. It's up 24,000. This is up since July, been up since July, and also up more than expected. And in machinery and fabricated metals, so people who are looking for any impacts on tariffs, both of those are up. Machinery up 8,000, fabricated metals up 4,000. Women and African American also the tightest unemployment we've seen in a while. For women, lowest since 2000. For African Americans, lowest on record, 6.6%, the lowest since 1972.
All right, thank you very much, Bloomberg's Katya Dmitrieva in Washington. The market on its foot now. You're seeing a lot of buying coming in. The 10-year yield feels like it's dropping like a stone. The dollar also turning negative. Futures market, though, still seems relatively calm, although off the lows of the session, as it feels like we're rethinking that potential stronger job market story on the margin. I mean, we're clearly still in a tighter labor market, but nonetheless, that 3.9% U3 unemployment, really interesting to see what's going to be the trigger for those higher wages, David.
Yeah, and rethinking the stronger dollar, too, a little bit. The dollar is off a little bit softer there. Joining us now is Subhadra Rajappa. She is Societe Generale, Head of U.S. Rate Strategy. Alan Kruger of Princeton University is still with us, so I'm going to push you here. Solid? Solid? I mean, come on, this is well below what's expected. I mean, 164, and also the hourly earnings rate is 2.6, not 2.7, not 2.8. You still think it's solid, Alan?
This is perfectly solid. And, you know, the miss on the top line jobs number is a pretty small miss in the scheme of things. The typical revision is plus or minus 50,000. Last month's revision, if you add that to this month, we're right on the expectation. What I would say was most interesting in this report was labor force participation.
I was just going to ask you that question.
I think if you would have asked people, unemployment rate's going to drop to 3.9%, and labor force participation rate is down over the last year. You know, President Trump ran on he's going to raise labor force participation. It's not happening. None of the policies are really focused on bringing people back to the labor force. So I think the market should focus a little bit more on that, frankly, because it suggests that we are going to hit some speed bumps when it comes to expansion. We're going to, sooner or later, we're going to be running out of workers if the recovery continues, and that will put more upward pressure on wages. But as you said, David, the wage number is a disappointment.
Yeah. So, Subhadra, let's turn to you here now. There is an issue with participation because President Trump has said that's his number one priority. At the same time, Mr. Kruger was the chief economist for President Obama. We should just notice that, okay? As we take a, but how do you react to these numbers? These look somewhat disappointing, even though they're solid, right, Ellen?
Yeah, they are, and that's reflected in the lower unemployment rate. I mean, we're 3.9%. The consensus going into this report was 4%. But the participation rate hasn't really meaningfully changed in the last 7 months because we've not seen people coming into the workforce. It's mostly driven by more macro factors like demographics. So that's what's really driving the participation rate lower. And the fear is that we might land up a lot sooner to 3.5% unemployment rate if the participation rate doesn't pick up.
So why hasn't the participation rate picked up? I don't understand. We keep adding. I mean, even 164, maybe it's disappointing, but it's more than the 125 you need to just stay even, right?
Oh, sure.
So we're adding jobs, and we've been adding jobs for month after month after month, and yet the participation rate does not go up. In fact, this time it went down a bit.
Right. Well, part of it is demographics. The workforce is getting older. Older workers have a lower labor force participation rate. And for the next 2 decades, that's going to put downward pressure on labor force participation. But the other factor is once people leave the labor force, they often rearrange their lives. They retire early. They take